Welcome to Griffonomics.
Glad to be here for this one.
Yeah, because, Wall Street just loves a clean medical x-ray of a company, right?
Yeah.
They
Yeah.
want the numbers to go up and up, well, perfectly straight line, quarter after quarter.
Right. No complications, no messy shadows on the scam.
Exactly.
Good.
But today, we are looking at a company that generated $1.98 billion, and they intentionally tanked their own quarterly margins on purpose.
Which is wild.
Right. Terrifying the public market.
Yeah.
And they did it all to build this multi-decade compounding machine.
Mm.
So we are unpacking the incredibly messy, highly lucrative transformation of Distribution Solutions Group, or DSGR.
Yeah, DSGR.
And if you're joining us on this deep dive, you are about to see how a company goes from being a legacy logistics distributor, just moving boxes, to a technology-enabled, multi-platform, specialty powerhouse.
It is honestly one of the most fascinating corporate pivots happening in the market right now. And to truly understand it, you kind of have to throw away the standard quarterly earnings playbook. You have to look past the surface level panic and dig deep into the structural foundation they are pouring right now.
I completely agree. And we have a phenomenal stack of sources to help us, map this out.
We really do.
We're pulling from DSGR's 2025 Annual Fiscal Performance Report. We've got their Q4 2025 earnings call transcripts, which are a gold mine, plus some brilliant, deeply granular analyst notes from Seeking Alpha.
Yeah, the Seeking Alpha stuff is great.
Right. And obviously the official SEC Form 10-K, and an incredibly revealing investigative YouTube interview from the Yet Another Value podcast.
And that specific combination of sources is, it's what makes this analysis so potent, really.
Yeah.
Because you get the raw, unvarnished quantitative data from the SEC filings, but you also get the qualitative narrative, the tone of voice, the subtle hesitations, the strategic framing from the management team.
And from the analysts who are actively interrogating them on those calls, right?
Exactly.
So our mission for this deep dive is to tear this company down to its studs. We are going to dissect the high-touch compounding analysis of DSGR. We're going to investigate the recent Q4 margin shock that sent the stock into a temporary tailspin.
A pretty violent one, yeah.
And most importantly, we are going to decode what management calls the J-curve theory of reinvestment.
Okay.
Let's unpack this.
So to understand why the financial anomaly of Q4 2025 happened and why the market reacted with such severe skepticism, we first have to understand the physical, concrete reality of what DSGR actually does on the factory floor.
Right. You can't understand the spreadsheet without understanding the supply chain.
Exactly.
So let's start with that physical reality. DSGR is fundamentally built on what we call the high-touch VMI mode. But before we define VMI, let's look at the four massive pillars, the primary segments that make up DSGR today.
Yeah, let's break those down.
First, you have Lawson. This is your classic MRO business.
Right. And MRO stands for maintenance, repair, and operations. So think C parts, route-based distribution. It's the nuts and bolts that keep a facility running.
Literally the nuts and bolts.
Literally.
Next, you have test equity. This is a totally different beast. They handle electronic test and measurement equipment, technical sales, calibration services for highly sensitive manufacturing environment.
Yeah, much more technical. Then you have Gexpro services, and their focus is heavily weighted toward the original equipment manufacturer, or OEM, side of the market.
Okay.
They don't just supply parts, they build these incredibly complex global supply chain programs for massive manufacturers. They are essentially the nervous system for an OEM's production line.
Oh, wow. Okay. And finally, you have the newly formed Canada Branch Division.
Right.
Which was created by combining two major acquisitions, Source Atlantic and Bolt Supply. And that instantly gave DSGR a massive, deeply entrenched geographic footprint across the Canadian industrial landscape.
It was a huge move.
Yeah. Now, across all these diverse segments, the magic acronym that ties this entire empire together is VMI, or Vendor Managed Inventory.
Yes.
And if you take absolutely nothing else away from this deep dive, you need to understand VMI. Because when most people think of distribution, they think of, a truck backing up to a loading dock.
Right. Dropping off a pallet of cardboard boxes, getting a signature on a clipboard, and just driving away.
Exactly. That is not what DSGR does.
No, not even close. VMI is an entirely different philosophy of logistics. In a vendor-managed inventory model, the DSGR sales representatives physically enter the customer's manufacturing plant.
Like they go inside.
They have security badges. They walk the factory floor wearing hard hats and steel-toed boots, literally side by side with the customer's mechanics and engineers.
That's crazy.
And they physically manage the thousands of little plastic bins of inventory, the screws, the specialized fasteners, the industrial chemicals, the micro solder.
So they aren't, like, waiting for the customer's procurement department to call them with an order.
Exactly. The DSGR rep is the one counting the parts. They're the one realizing a bin of specialized titanium bolts is running low, and they are the one reordering it, receiving it, and restocking it before the customer's mechanic even realizes the bin was ever at risk of being empty.
Wow.
It is a seamless, invisible service.
And the financial result of that invisibility is absolutely staggering. I mean, looking at the sources, we were talking about revenue retention metrics that just defy gravity for an industrial business.
Oh,
They report greater than 92% retention for the Lawson segment.
which is high.
Very high. And for Gexpro, it is an astonishing 98% retention, with 70% of their total revenue locked up under rigid long-term agreements.
What's fascinating here is how counterintuitive that sounds to anyone who has ever run, like, a traditional retail or wholesale business.
Right.
In a normal market, if you sell screws, your customer is constantly shopping around to see if someone else sells those exact same screws for half a penny less.
It's a race to the bottom on price.
Always. So how does DSGR maintain 98% retention in a market flooded with cheap overseas components?
Right. Like, why doesn't the customer just fire DSGR, hire a cheaper supplier, and save, 5% on their annual hardware budget?
Because the business DSGR is in isn't actually about product pricing. It comes down to absolute risk mitigation.
Okay.
The customer is not price shopping a box of screws because the wholesale cost of that component is mathematically irrelevant compared to the catastrophic cost of a service failure.
Let's make this tangible. The sources use this great example of United Rentals, a massive equipment rental company. Walk us through a day in the life of a United Rentals repair depot.
Sure. So imagine a massive multi-million-dollar earth-moving excavator sitting in a United Rentals repair bay.
Okay, giant machine.
Right. It needs a routine maintenance overhaul before it can be sent back out to a construction site where it rents for thousands of dollars a day.
Thousands a day, got it.
So the mechanic is in the middle of the engine block.
Yep.
He reaches into a bin for a highly specific $1 high tensile fastener, and the bin is empty.
Uh-oh, so the entire overhaul stops.
The overhaul stops cold. The mechanic, who is making, say, $45 or $50 an hour, is now standing around doing nothing.
Right.
The service manager has to stop what they are doing, get on the phone, and try to source this one specific bolt. Maybe it takes 2 days to get it shipped overnight from a secondary supplier.
Wow.
And for those 2 days, that multi-million-dollar asset is sitting idle on the lot. It is generating zero rental revenue. The construction company that was supposed to rent it is now furious because their project is delayed.
So the ripple effects are massive.
Massive. You are talking about thousands, potentially tens of thousands of dollars in lost revenue, wasted labor, and reputational damage, all because of a missing $1 piece of metal.
That puts it in perspective.
Right. So when the United Rentals procurement officer looks at their budget, they do not care if DSGR charges them $1.10 for that fastener, while a competitor might charge 95 cents.
Yeah, that 15 cents doesn't matter.
Not at all. The pennies saved on the hardware are completely eclipsed by the insurance policy that VMI provides. DSGR is not selling fasteners. They are selling guaranteed uptime. They are selling sleep-at-night insurance for facility managers.
I love that framing. I was actually trying to think of an analogy for this that strips away all the industrial jargon. And it's kind of like having a high-end personal chef in your home.
Okay, I like where this is going.
Right, because you don't just hire a private chef to stand at the stove and cook a meal. You hire them to manage the entire complex ecosystem of your kitchen.
Yeah.
They're the ones who notice you're running low on almond milk on a Tuesday afternoon. They don't come and ask you about it. They just magically replace it.
Exactly.
So that on Wednesday morning at 6 a.m., you don't pour yourself a dry, depressing bowl of cereal. You are paying a massive premium for the seamlessness of your morning routine, not for the wholesale cost of the dairy.
That is a perfect mathematically aligned analogy. You are outsourcing the cognitive load of inventory management. The CEO of a manufacturing plant wants their engineers focused on designing better products and their mechanics focused on turning wrenches. They do not want highly paid technicians walking around with clipboards doing cycle counts on 38-inch washers.
I guess it's a huge waste of money.
It is an incredibly inefficient use of human capital. By embedding themselves into the facility, DSGR completely removes that cognitive and operational burden.
Wait, I'm struggling with the math here on the human element, though.
How so?
Well, if I give my personal chef the corporate credit card, and they are the sole authority deciding when the milk is low, Human nature suggests they might start buying like 5 gallons of premium imported milk I don't even need just to pad their weekly grocery budget.
Ah, I see.
Right. If the DSGR sales reps literally have the keys to the kingdom, and they are the ones physically walking the factory floor deciding what gets ordered, how does DSGR stop these reps from artificially stuffing the bins? What stops a rep from saying, you know what, I'm a little behind on my monthly quota, I'm going to order an extra 5,000 screws for this bin that doesn't really need it?
That is the single most common and frankly most valid critique of the VMI model from outsiders. It looks like a massive conflict of interest.
Yeah, the fox guarding the hen house.
Exactly. But the answer to why that doesn't happen at scale lies in the fundamental unwritten rules of route-based sales. This is a highly relational, trust-based business. We are not talking about a faceless software subscription. We are talking about a human being.
Right, a specific guy or girl who shows up every Tuesday at 9 a.m.
Exactly. A long-tenured DSGR sales rep might be visiting that exact same United Rentals facility or that exact same Boeing plant every single week for a decade. They know the floor managers by their first names. They know the mechanics' kids' names. They bring donuts on Fridays.
It's a real relationship.
It is an incredibly sticky, personal relationship. If a rep decides to artificially pad an order by 30 cents or toss an extra box of expensive drill bits into a bin that clearly doesn't need it, they are risking a multi-year, highly lucrative, six-figure commission relationship over literal pennies.
So the incentive structure flips. Short-term greed is actually economically irrational for the rep.
Precisely. If they lose that trust, they get kicked out of the plant. If they get kicked out of the plant, they lose the account. And because they might sell 75,000 fasteners to that specific customer over the next 5 years, burning the relationship for a quick, unneeded $50 sale today is just career suicide. It simply doesn't happen often enough to be a systemic risk.
And I imagine the customers aren't totally blind, right? They must have some level of oversight.
Oh, absolutely. The customer's procurement and finance departments do eventually audit these consumption rates on a macro level.
Okay, good.
Like if the production output of the factory stays flat year over year, say they built 100 tractors last year and 100 tractors this year, but their fastener and chemical consumption suddenly spikes by 20%, massive red flags go up in the accounting department.
Right, that math doesn't work.
The VMI rep knows this, so the system polices itself through mutual dependency and long-term economic alignment. The rep only makes money if the factory stays healthy and efficient.
Okay, that makes perfect sense on a micro level. Managing a few bins in a local garage, relying on trust and donuts is one thing, but doing it on a massive global scale requires an entirely different level of complexity.
It's a huge leap.
Because once you move past a few thousand parts, human memory and personal relationships hit a natural ceiling. That's where this story shifts from a blue-collar logistics problem to a Silicon Valley data problem.
And that transition is the core of DSGR's modern identity. The scale of their ecosystem today is truly difficult to conceptualize.
Yeah, let's look at the numbers.
We are looking at a company that actively services over 220,000 distinct customers.
220,000.
Yes. They source their products from more than 10,000 different global suppliers, and they actively manage over 760,000 unique SKUs.
Wait, 760,000 unique parts?
Yep.
That is mind-boggling. I mean, try to picture a catalog with 750,000 different items, many of which look almost identical to the naked eye, but have vastly different metallurgical properties or shear strengths.
It's wild. And what is brilliant about this from a macro risk management perspective is the absolute lack of supplier concentration.
How so?
Well, in the distribution business, your biggest existential threat is being overly reliant on one vendor. If you buy 40% of your product from one manufacturer, they own you. They can dictate your margins. But for DSGR, absolutely no single supplier accounts for more than 5% of their overall purchases.
Wow. That fragmentation is an incredible defensive shield. If one supplier suddenly gets greedy and raises prices unreasonably or goes bankrupt or, suffers a catastrophic factory fire, DSGR doesn't panic.
Not at all.
They just seamlessly route that demand to one of the other 9,999 suppliers in their network. They are never held hostage by the supply side of their own business.
Exactly. But to your earlier point, you cannot manage 760,000 SKUs and 10,000 suppliers with clipboards and Excel spreadsheets. The complexity would crush you.
Right. The human brain can't do it.
And this is where DSGR is flexing its technological muscles. They have rolled out an initiative they call Digital Alpha.
Digital Alpha. Let's dig into that.
They are utilizing advanced AI and machine learning algorithms for SKU-level predictive inventory and price elasticity analysis.
Let's break down what price elasticity analysis means in this context, because that sounds like a dry textbook term, but it's actually a massive profit driver.
It really is. Imagine you have 760,000 items. Historically, a distributor might just say, let's raise all prices by 2% this year to cover inflation.
Which is a very blunt instrument.
Extremely blunt. It pisses off customers who buy high-volume commodity items, and it leaves money on the table for highly specialized rare items where the customer is totally price insensitive.
Right, the customer doesn't care what the rare item costs, they just need it right now.
Exactly. Digital Alpha uses AI to analyze millions of transaction points to determine exactly how sensitive a customer is to the price of every single specific SKU.
Oh, wow.
So the algorithm might say, for this generic half-inch steel washer, the market is highly competitive. Keep the margin tight. But for this highly specialized, aerospace-grade, left-handed, threaded titanium bolt that only 3 factories in the world make, the customer has zero price sensitivity. You can raise the price by 12% and they won't even blink.
So the algorithm is just finding hidden pockets of profit margin across 750,000 items. That is incredible. Yeah. And they are also using data to optimize their human capital, right?
Yes, they are.
Because I read in the transcripts that CEO Cesar Lanza is actively restructuring the sales force based on data analytics.
Yes, and it's a ruthless but necessary optimization. Lanza is looking at the gross profit dollars generated per hour of a salesperson's time.
Makes sense.
If you have a highly paid, highly technical field rep driving 2 hours out into the middle of nowhere to service a tiny client that only buys $500 worth of gear a year, you are losing massive amounts of money on that relationship. The travel time alone destroys the profit margin.
So what do? Just abandon the small customers entirely?
No, they digitize them. They use the AI to identify these uneconomic accounts, and they transition them away from the expensive, high-touch field reps. They move them to inside sales teams or entirely automated digital portals.
That's smart.
The customer still gets their parts, but DSGR strips out the massive labor cost of servicing them. They are reserving their most expensive asset, their field reps' time, exclusively for the massive, high-yield enterprise accounts.
And that data superiority is the essence of what the analysts call the many-to-many network effect. Because the inevitable question that always comes up when you talk about distribution is the 800-pound gorilla in the room, Amazon.
Yeah, always.
People always ask, why can't Amazon Business just crush DSGR? Amazon has the greatest logistics network in the history of human commerce. They have unlimited capital. Why don't they just eat this market?
It is a great question, but it fundamentally misunderstands what Amazon is built to do. Amazon is the ultimate one-to-many model.
Okay, unpack that.
It is designed for standardized, highly commoditized, high-volume products. They want to put 1 million identical spatulas in a warehouse and ship them to 1 million different houses. They are brilliant at that.
Unbeatable.
But they are completely unequipped to handle highly specialized, custom-engineered, hyper-fragmented industrial ecosystems.
Right. Because if a Boeing factory floor manager needs a highly specific chemical bonding agent that requires temperature-controlled storage, strict hazardous materials handling protocols, and a technical engineer to explain how it interacts with a new carbon fiber composite.
Amazon is not going to send a guy in a blue vest to figure that out.
Exactly.
Amazon provides logistics. DSGR provides engineering translation and customized supply chain integration. In a hyper-fragmented market where you have tens of thousands of highly specific, nuanced needs matching with tens of thousands of highly specific niche suppliers, the entity that sits in the middle and aggregates that complexity becomes absolutely indispensable.
Yeah.
The more complex the market gets, the more valuable DSGR becomes. They are the translator between the supplier's massive catalog and the mechanic's specific wrench.
Here's where it gets really interesting. DSGR isn't just a middleman sitting at a computer routing orders. In their test equity segment, they actually manufacture their own products.
Right.
Specifically, they build environmental test chambers right here in the United States. Now, producing heavy industrial equipment domestically isn't just about a nice marketing slogan. It is a highly calculated, ruthless, macroeconomic chess move.
Absolutely.
The management team refers to it as a domestic hedge. By building these test chambers in the U.S., they are specifically insulating themselves against global tariff fluidity, particularly the ongoing risks of Chinese import tariffs.
And that's a critical strategic layer. Now, just to be clear, and regardless of where anyone stands on international trade policy of China, we're completely impartial here on the politics.
Right. We are purely looking at the math and the supply chain facts as presented in the SEC filings. No political stance whatsoever.
Exactly. The macroeconomic reality for a global distributor is that tariffs create massive cost volatility. If you are importing 100% of your products from overseas, a sudden 25% tariff on industrial electronics can wipe out your entire profit margin overnight.
Yeah.
You either eat the cost, which destroys your earnings, or you pass it on to the customer, which destroys your competitiveness.
Right. It's a completely unpredictable variable. You are at the mercy of geopolitical news cycles.
Exactly. By manufacturing these high-value, complex test chambers domestically, DSGR takes that variable off the table for a critical portion of their revenue stream. They control the labor, they control the materials, and they completely bypass the international shipping lanes and the customs duties.
It stabilizes their cost of goods sold.
It is pure mathematical risk mitigation disguised as manufacturing.
So if we step back and look at the whole picture so far, you have this incredibly sticky VMI mode that generates 98% retention. You have a massive network of 760,000 SKUs protected by AI pricing algorithms. And you have strategic domestic manufacturing to hedge against geopolitical risk.
It's a very solid base.
Managing this level of complexity successfully generates massive, continuous streams of free cash flow. But here is the pivot. DSGR doesn't just take that cash and sit on it. And they don't just grow organically by trying to sell a few more screws every year.
No, they don't.
They use that cash to feed a highly engineered, relentless acquisition machine.
And that brings us to the financial engine of this entire thesis. The buy and build strategy backed by Luther King Capital Management, or LKCM, and their CEO, Bryan King. You really cannot understand DSGR's future without understanding the DNA of its ownership.
Let's talk about LKCM, because they aren't just passive investors who bought some stock and are waiting for dividends.
Not at all.
They are the architects of this entire M&A compounder strategy. They have a multi-decade track record in the specialty distribution space. They deeply, fundamentally understand the mechanics of buying smaller regional mom-and-pop distributors and integrating them into a massive national platform.
And the core financial mechanism driving this strategy is a concept known in private equity circles as multiple compression.
Multiple compression. It sounds like dense Wall Street jargon, but it is actually an incredibly elegant and logical way to build wealth.
It really is.
According to the SEC filings and the analyst notes, DSGR has a proven historical track record of buying specialized businesses at an average multiple of 7.7x EBITDA. Then, within about 15 months of owning them, through aggressive synergies, they compress that effective multiple down to 6.3x.
Let's translate this for a second, because the math is the whole secret to the company.
Yeah, I like to think of multiple compression like house flipping on a massive corporate scale.
Yeah, that's a good way to look at it.
Right. So imagine you buy an outdated house in a great neighborhood. You pay a premium for it because the neighborhood is good. Let's say you pay 7.7 times what it currently generates in rental income.
Okay.
But because you already own the lumberyard and the plumbing company and the electrical contractor, you can renovate that house at cost. You install a new kitchen, you fix the roof, you upgrade the bathrooms.
Right.
Suddenly you can charge double the rent. Because the rental income has skyrocketed, the relative price you originally paid for the house suddenly looks like a massive bargain in hindsight. You effectively bought it cheaper than the headline price suggested.
That is a phenomenal analogy. When DSGR buys a company for 7.7 times its earnings, they're paying a fair market premium. But the moment the ink dries on the contract, they start renovating the house.
They get right to work.
They slash redundant operational costs, they merge the HR departments, they consolidate the warehouses, they negotiate better shipping rates using DSGR's massive scale. That cuts expenses.
Yeah.
Then they pump new revenue through the acquired company's Salesforce. The earnings of the acquired company shoot up. And since the purchase price is locked in the past, but the earnings are rising in the present, the ratio of price to earnings compress. They manufactured value out of thin air through operational efficiency.
And the sources provide a perfect real-world example of this house renovation in action. Let's look at the Keysight example.
Oh, the Keysight deal is textbook.
DSGR acquired a smaller distribution company called Tequipment. Now, on its own, Tequipment was a solid, profitable little business. But the moment DSGR bought them, they unlocked a massive synergy. DSGR gave Tequipment Salesforce immediate access to sell products from Keysight.
And for those who don't know, Keysight is the absolute dominant 800-pound gorilla in the electronic test and measurement manufacturing space.
Right. Instantly, overnight, Tequipment reps could walk into their existing customers' facilities and say, hey, we know you already buy all your standard gear from us, but guess what? As of today, we can also supply you with top-tier, premium Keysight oscilloscopes and spectrum analyzers.
It dramatically scales their revenue without having to acquire a single new customer.
The analyst sources indicate that these cross-selling synergies across the newly integrated platforms are targeting roughly $50 million in pure new revenue.
$50 million just from cross-selling. And DSGR is not creating this M&A strategy as a side hustle. They are professionalizing the entire funnel to do this at a massive scale.
Yeah. They recently hired an executive named Sean Dwyer as their head of strategy and M&A. This is a guy with over $30 billion in transaction experience on his resume.
$30 billion?
You don't bring in a heavyweight dealmaker with a $30 billion track record unless you are planning to build an absolute behemoth of a platform.
And they have secured the raw financial firepower to let him do it. In December 2025, management proactively amended and expanded their senior credit facility to a staggering $1.1 billion.
That's a huge war chest.
It really is. That is composed of $700 million in term debt and a $400 million revolving line of credit. And crucially, they pushed the maturity of that debt all the way out to 2030.
That's just they have time.
Plenty of time.
Yeah.
They secured over $1 billion in dry powder while keeping their net debt leverage ratio at a very safe, a very conservative 3.5x. They are locked and loaded for the next half-decade of acquisitions.
Okay, wait. I have to play devil's advocate here.
Go for it.
If buying companies is this easy and this lucrative, just borrow $1 billion, buy a regional competitor, cross-sell their products, cut their HR department, and watch the cash roll in, why isn't every distributor on Earth doing it?
Well,
it sounds like a cheat code for capitalism.
right.
But human nature and corporate history tell us that smashing dozens of different corporate cultures together is usually a nightmare.
Oh, it's brutal.
You are integrating ancient legacy IT systems from the 1990s into your modern AI platform. You are trying to align competing sales teams who used to literally hate each other. Doesn't that immense friction eventually cause the wheels to fall off the entire machine?
You've hit on the exact vulnerability of the model. It is incredibly difficult, and the friction is immense. Most companies fail at this because they engage in standard private equity financial engineering.
Right.
They just lever up the balance sheet, fire half the staff to make the margins look good for one quarter, and then the underlying business rots from the inside out.
Right, the classic strip and flip model.
Exactly. But DSGR management insists they are driven by commercial logic, not financial engineering. Because of the VMI moat, when they buy a company, they aren't just buying a spreadsheet. They are buying access to deeply entrenched, highly trusting customer relationships.
That makes sense.
But you are absolutely right about the operational pain. Integrating IT systems is agonizing. Retraining sales reps takes months. Consolidating warehouses disrupts delivery routes. And that exact agonizing friction you just described is precisely what caused the massive, terrifying Q4 2025 earnings shock.
Which perfectly transitions us to the absolute bloodbath that was the Q4 earnings report and what management calls the strategic inflection point.
Yeah, let's get into it.
But before we get to the bad news, we have to acknowledge the full year 2025 triumphs because the context is crucial here. If you only looked at the annual numbers for 2025, you would think DSGR had a flawless year.
The annual numbers were spectacular. They posted record consolidated revenues of $1.98 billion. That is up 9.8% year over year.
Including 3.6% organic growth, right?
Exactly, plus 5 acquisitions. And they generated a massive $84 million in operating cash flow. And they achieved a roughly 85% free cash flow conversion rate.
Wow.
For an industrial distribution business, turning 85% of your earnings into pure, unencumbered cash is elite-level performance.
But Wall Street analysts don't live in the annual reports.
No, they don't.
They live and die by the 90-day cycle. They want their clean X-ray every single quarter. And the Q4 2025 numbers were a genuine, unmitigated shock to the system.
A total shock. Adjusted
EPS came in at 18 cents, missing analyst estimates by a staggering 14 cents. Q4 revenue growth essentially flatlined, stalling out at a mere 0.2%. And the real gut punch, the metric that set the algorithms into a selling frenzy, Adjusted EBITDA margins compressed violently, dropping from 9.3% in the prior year down to 7.4%.
A nearly 200 basis point drop in EBITDA margin in a single quarter is severe. In a low-margin distribution business, that kind of contraction signals a 4-alarm fire to institutional investors.
Just to ground this for our listeners who might not breathe financial jargon every day, 150 basis points is exactly 1.5%. Now, 1.5% doesn't sound like a lot if you're talking about like a tip at a restaurant.
Right.
But when your baseline profit margin is only 9%, a 1.5% drop means your actual profits just evaporated by nearly 20%. It is the difference between a record-breaking year and a disaster.
Exactly. When the market saw that 7.4% figure flash on the terminal, it panicked. But if we dig deeply into the earnings call transcript, management did not hide from
No,
this.
they faced it head-on.
They didn't blame the weather or offer vague macroeconomic excuses. CEO Bryan King explicitly stood up, stated they fell short of expectations, and owned the results completely.
And CFO Ronald Knudsen meticulously broke down exactly what caused the margin collapse.
He really did.
Because it wasn't a systemic failure of the VMI model. It was a highly specific 150 basis point perfect storm of isolated headwinds. Let's walk through this perfect storm, because it's fascinating to see how multiple, seemingly unrelated fires can combine to create a massive blaze on an income statement.
It's like death by 1,000 cuts.
Literally. First, they took a 40 basis point hit purely from healthcare costs.
Yes. Large corporations often self-insure their employees up to a certain threshold. It saves money in the long run, but it exposes the company to short-term volatility. In Q4, DSGR simply experienced an unexpected, statistically anomalous spike in major employee medical claims.
So it is a real cash expense, but it has absolutely nothing to do with the health of their distribution network.
Exactly. It's an actuarial blip. Second, they faced another 40 basis point headwind from 2024 timing benefits that simply didn't repeat in 2025. Basically, some accounting tailwinds from the previous year vanished, creating a tough year-over-year comparison.
Okay, that's 80 basis points right there.
Right.
Third, and this is where the strategy starts to reveal itself, they proactively absorbed 25 basis points in talent and leadership startup costs.
This was entirely voluntary.
Right. They are actively going out and paying top dollar to poach high-level executives like Sean Dwyer to build out that M&A machine we discussed. They're paying for future growth out of today's earnings.
Fourth, there was a 25 basis point drag from a shift in their sales mix. During Q4, they happened to sell a higher volume of lower-margin test and measurement equipment and a lower volume of their high-margin renewable energy products.
Again, a temporary fluctuation in customer demand, not a permanent structural flaw.
And finally, a 20 basis point hit from bad debt reserves. In an uncertain economy, accounting rules require you to set aside a little extra cash for customers who might potentially default on their invoices. You add all those micro-cuts together, the healthcare, the timing, the hiring, the sales mix, the bad debt, and you get your massive margin collapse.
So what does this all mean? The market looked at those numbers and sold the stock. But here is the critical, defining part of this entire deep dive. DSGR management didn't view this quarter as a disaster.
Not at all.
In fact, they almost seemed to welcome the friction because they introduced what they call the J-curve theory to Wall Street. They explicitly stated that 2025 was always intended to be a digestive retooling year.
The J-curve concept is the absolute master key to understanding DSGR right now. If we connect this to the bigger picture, a J-curve is a visual representation of a profound transformation. If you trace the letter J, the line goes down before it hooks back up and goes infinitely higher than where it started.
Right.
Management deliberately took a margin hit. They willingly, consciously sacrificed short-term profitability to fund these leadership acquisitions, to build out their AI digital alpha tools, and to endure the messy friction of restructuring their sales force.
They're basically tearing up the floorboards while they're still living in the house.
Exactly. They're projecting that these painful investments today will lead to a massive structural releveraging of margins by mid-2026.
Mid-2026, okay.
Once the IT systems are unified, once the AI is fully deployed, and once the new executives start closing deals, the margins won't just recover to 9%. They will structurally elevate to a new baseline.
We are witnessing an incredibly rare event in public markets. Think about the psychology here. You have a public company CEO standing up in front of Wall Street analysts, a group of people who are famous for demanding instant gratification and punishing any deviation from consensus.
Oh, no, they are ruthless.
And he's saying, we are going to make less money right now on purpose. We are going to look bad on paper for the next 12 months because it's the right thing to do for the next decade.
Yeah.
It borders on corporate madness. Most Fortune 500 CEOs would be fired by their board of directors the next morning for saying that.
Because most Fortune 500 CEOs are incentivized by short-term stock options. If a typical CEO faces a tough quarter, they will simply cut research and development, freeze all hiring, and slash the marketing budget to artificially prop up that quarterly margin.
They get their bonus.
Exactly. They hit their 9% target, collect their annual multi-million-dollar cash bonus, and let the company slowly technologically decay over the next 5 years. They trade the future for the present.
So how is Bryan King surviving this? The only reason a CEO can survive a brutal quarter like that, look Wall Street in the eye, and essentially tell them to be patient, is if they are completely structurally insulated from the short-term pressures of the market.
And the only way to be insulated from the market is to literally own the company. Which brings us to the final piece of the puzzle: the ownership structure, market skepticism, and the final verdict.
Right.
The ownership concentration here isn't just a footnote. It is the gravity that holds the entire J-curve strategy together.
Let's look at the cap table. Luther King Capital Management, along with CEO Bryan King and the broader King family, own a massive, overwhelming 78.7% of the entire company.
Almost 80%. It is the ultimate owner-operator setup. This is basically a massive private equity firm operating in the body of a publicly traded company.
It really is.
Consider this detail from the filings. CEO Bryan King takes zero cash compensation. Nothing. No salary, no cash bonuses.
Wow, zero.
His entire financial upside, his entire net worth tied to this venture, is based on the long-term equity value of the business. Furthermore, LKCM affiliates maintain a rigid 30% capital commitment to the fund holding these shares. They are eating their own cooking. The incentive alignment between management and the stock price is ironclad.
And it isn't just the King family. The incentive structure goes all the way down the executive chain. The CEO of the massive Lawson segment, Cesar Lanza, holds stock options with strike prices tiered all the way up to $70 a share.
Which is huge considering where it's trading now.
Right. Remember, the stock is currently trading in the mid-20s. Lanza doesn't make the big life-changing money unless he literally triples the value of the entire company.
Because of this radical ownership structure, management absolutely does not care about smoothing out quarterly earnings to hit an artificial Wall Street consensus. They are not managing for the next 90 days to appease a hedge fund manager in New York. They are architecting a multi-decade compounding machine. If they have to absorb a 7.4% margin for a few quarters to build a billion-dollar AI platform, they will do it without blinking.
But let's be realistic. This structure creates intense skepticism in the broader market. There are real risks here for an individual investor. First and foremost, limited minority voting power. With LKCM owning nearly 80%, retail investors essentially have zero say in how this company's run. If you buy shares, you are a passenger.
Very true.
Second, because 80% of the shares are locked up in a vault, the stock liquidity is very low. With so few shares floating in the public market, the stock price can be highly volatile on very low trading volume.
Third, as we discussed extensively, M&A integration friction is a constant ongoing threat. Every time they buy a company, they risk indigestion. And finally, we have to mention tariff fluidity again. We talked about the domestic manufacturing hedge, but they still have indirect, massive exposure to global supply chain costs, particularly via steel tariffs. A huge portion of their fasteners and industrial parts are reliant on raw steel pricing, which is highly sensitive to geopolitical shifts and trade policies.
And just to reiterate for our listeners, we are noting the financial risks of these steel tariffs and China trade policies purely as an economic mathematical variable discussed in the analyst reports. We aren't taking any position on the underlying politics.
Of course not. Impartial facts only.
The cold, hard reality for DSGR is simply that raw material costs could fluctuate unpredictably. And that is a risk the business has to manage.
Precisely. So taking all of this massive complexity into account, the incredibly sticky VMI moat, the aggressive multiple compression M&A engine, the painful but necessary J-curve margin shock, and the overwhelming insider ownership, what is the final verdict from the financial analysts who cover this stock?
The consensus from the deep dive sources is a resounding, strong BUY, classifying DSGR as a rare long-term compounder. Trading in the mid-20s, the analysts estimate it offers an 11% internal rate of return, or IRR, based purely on its organic free cash flow generation.
And here is the kicker. That 11% floor doesn't even factor in the massive upside from future acquisitions fueled by that new $1.1 billion credit facility.
That's just the baseline.
Exactly. And the board of directors clearly agrees with the analysts that the stock is currently mispriced because they just signaled their absolute confidence by adding an additional $30 million to their share repurchase program.
They're putting their money where their mouth is.
They looked at the Q4 sell-off and immediately started buying their own dip. The long-term target EPS modeled out by management is a staggering $5 per share.
Synthesizing this entire investment thesis, the core argument is that the market is fundamentally mispricing DSGR right now because it is reacting emotionally and reflexively to the bottom of the J-curve. Wall Street algorithms see a 7.4% margin and they blindly execute sell orders. But the owners, the people with 80% of their net worth on the line, see the structural investments taking root, they see the AI platform coming online, and they are buying everything they can.
It is a classic time horizon arbitrage. The market is playing checkers over a 90-day timeline. DSGR management is playing three-dimensional chess over a 10-year timeline.
But I have to ask you this, from the perspective of our listener who might be evaluating this company. If LKCM owns nearly 80% of the voting power, are retail investors just along for the ride in the backseat with a plastic steering wheel?
Pretty much.
I mean, if management suddenly decides to do something completely counter to minority shareholder interest, like take the company private at a low-ball valuation, you literally cannot stop them. Is this extreme illiquidity and absolute lack of control a feature, or is it a fatal bug for the listener?
It's the ultimate double-edged sword of investing, and it depends entirely on your personal philosophy. If you believe you are a superior capital allocator and you want to actively agitate for quarterly dividends or share buybacks, then being in the backseat is a massive bug. You will hate this stock.
Right.
But if you recognize that this management team has a proven 20-year track record of generating wealth in specialty distribution, and you see that they are foregoing cash salary to invest their own capital alongside yours, well, then being in the backseat is a feature. You are getting a free ride with an expert driver who has absolutely everything to lose if they crash the car.
You are trusting the pilot to land the plane safely, because the pilot's entire family is sitting in the front row.
Exactly. The illiquidity and the weird ownership structure actively deter the day traders and the short-term hedge funds. It filters out the noise, which leaves the register open purely for long-term compounders who understand the mechanics of the J-curve.
This brings us to the ultimate takeaway for you, the listener. Whether you are analyzing DSGR for a financial portfolio, managing a team of employees, or just navigating the trajectory of your own career, the core, undeniable lesson here is about the courage required to execute a J-curve in real life.
Yeah, that's a great point.
It is absolutely terrifying to watch your metrics go down. It's painful to take a short-term hit to your margins, to drain your savings to go back to school, or to take a demotion in title, to pivot into a new, higher growth industry.
It goes against all our instincts.
The natural human instinct is to protect the status quo. But DSGR proves that if you have a structural moat, if you are genuinely indispensable to your customers or your employer, you can survive the dip. You have to be willing to take the brutal hit today to fundamentally alter the structural trajectory of your tomorrow.
And looking at how DSGR is executing that transformation leads to a lingering, deeply provocative question about the future of this entire industry. DSGR is pouring millions of dollars into digital alpha and AI predictive inventory models.
Millions.
As these algorithms become infinitely smarter, eventually capable of predicting mechanical failures and supply shortages before they happen with perfect mathematical precision, this raises an important question. Will the sheer efficiency of technology eventually render the high-touch human sales rep obsolete? Or is a physical presence of a human being, a trusted face, standing on a chaotic, noisy factory floor, bringing donuts and shaking hands, the ultimate undisruptible moat that no algorithm can ever replace?
It's the ultimate tension of the modern economy, the cold perfection of the algorithm versus the messy trust of the human handshake. And in a world that is completely obsessed with automating everything, placing $1 billion bet on human relationships might just be the most contrarian and profitable trade of all, risk-defined, portfolio protected.